co-op business or small business that makes a living for the owner and the family there in that community. And so that's our focus of what we're looking at. A couple of quick things that show that is in a publicly traded company, there are really two ways to make a living, and comparatively speaking. One is they sell their product or service, of course, and the other is they sell corporate shares of stock or equities. A good example of that, of course, is Coca-Cola, a wonderful company out of Atlanta. But they sell their product all over the world, and they make money selling their product and services. They also sell corporate shares of stock. So they issue 30 million shares of stock at a certain price and take it to the stock market and sell that. That's a whole barrel full of money in addition to what they make selling their product. The small business normally only has one source of income, and that's the sale of their product or service. And that's the income stream. They're not selling corporate shares of stock. Makes a huge difference. Another quick difference analogy there is I like analogies. So I call big business rules football rules, and small business rules baseball rules. They're both ball games, but it sure is a different set of rules. And so we have to kind of establish that here at the front. The accounting on a publicly traded company is an audited statement. In other words, all of the financial data and everything is audited by accounting firms, and they certify that that's true and accurate information for that period of time of the economic process of that business. In our business, we deal occasionally with a reviewed statement as a second type of statement. It's not audited, but the accounting firm does spot check things and say we are comfortable this is a fair portrayal of the economic activity of this business for the last 6 months or year or whatever. But we normally deal in what we call compiled statements. And compiled street definition is I put all my receipts in a shoebox and turn them over to my accountant, and he files my tax return. I don't know how he did it, and the only thing I care about is how big a check I have to write for taxes. And so ordinarily, the financials in a small compiled business are actually done more to minimize taxes on a year-to-year basis than they are to demonstrate earnings. And that becomes a challenge when we go to sell. We're going to be talking about that a little bit different from there. The defining big business usually we would say is certainly Walmart, Exxon, Coca-Cola, all of the huge companies. Those are big companies, but the SBA even defines a big company as one that does 50 million up to say 100 million in sales. Wow, that's a huge business. A small business that we deal with normally probably does $1 million to $1.5 million in sales, up maybe 2 million. And that's what we call a Main Street business by financial sales and things. And we'll be talking more about that as we go through this today. But the publicly traded business, usually even our marketplace might go from $2 to $5 million. That's about 98% of businesses in the world fall into those categories. They would do $1 million to $2 million in sales or less. And that's our marketplace normally, both in selling a family business and helping somebody buy a family business. The Small Business Administration was founded, of course, in 1953 in the Eisenhower administration. And their mission then, and still is, to help Americans start, build, and grow businesses. One of the things we'd like to do with our educational program is also add the start a business with the prospect of buying an existing successful business. There are a lot of reasons for that. We're going to be talking about those as we go through our seminar here today. We've got, and the motivation of the financials are different, and I'll mention this as we move on. A publicly traded company wants to show earnings. They want to show profits. They want to show growth. Look how well we're doing. Buy our stock. A small, privately held business, family business, you don't see their financial information. And their financials are done to record the activity of that, and they have to file a tax return, so they work with their accountant to do that. They don't oftentimes use the financial data to help manage the business the way you do with a big business. And that's a little bit of a change, too, between football rules and baseball rules. Small business, baseball rules. They're privately owned normally, and we aren't selling the stock of that company like we're selling the shares of stock of Coca-Cola or IBM or Walmart, anything like that. They compile tax returns. They're not audited, so the accountant doesn't say, I audited this and I certified these are absolutely correct. As a matter of fact, they put a letter in front of the financials that says all of this information has been provided by the management. And management has chosen not to do anything now to comply with the requirements of GAAP financing, general accepted accounting practices. So therefore, this information, we use it to file a tax return, but we didn't audit any of it. We didn't check the inventory. We didn't verify sales. We do no due diligence. The manager is responsible for this information. So that's the world we deal in just a little bit. So we need the manager, the owner manager, to help us explain to us the financials and help us derive the actual earnings of that business based on the information that they give us, including the financials and tax returns. But other things come into their play too, and we'll talk about that a little bit. But the biggest difference probably is you rely much more, I do, and recommend you do, on valuing the business based on sales as far as a small business. If there's no sales, there's no business. Doesn't matter how much equipment, the inventory, things you got. So the sales, the gross sales of a business, are the market's response to that business's product or service. And so that trend of sales oftentimes can give you a good indication of that value that we're going to be talking about. Now, we've had some real loopholes, as Son can tell you, and we'll talk about it a little bit later. But between the pandemic, which changed a lot of the dynamics of small and big business, and the fact that a lot of folks started working remotely and now don't want to come back necessarily back to an office setting, has made for us change. The Amazon effect, I call it, has affected most all businesses, where you simply pick up the phone just like my wife does, and they're at the front door tomorrow, and we didn't have to go anywhere to shop. So the retail space and things is all, big retail companies are shifting significantly to adopt a different marketplace based on that. So we're going to be talking a good bit about how sales affect a business. But basically, with our size of a business is usually one that does anywhere from $500,000 up to $1.5 million in sales. That's probably going to be our sweet spot as far as Main Street business is concerned. And normally those businesses may be making their owner anywhere from $65,000 to $150,000 a year, because it takes about that at a minimum to make a living in America. And so when a buyer's looking at a business, what it needs to look at and focus on is, if I buy this business, how much could I make? Now, we're going to be talking about that in a minute. One of the terms we'll use is SDE, is seller's discretionary earnings, because that's different than just a profit. When you take just an overview of a business, you got your sales, you got your expense, cost of goods sold, and you got your expenses. And then what's left are the earnings to some of the pre-tax profit at a certain level. But some of those expenses benefited the owner or the owner's family, and not showed as income to them, but it is cash flow, that it is a benefit to them, and I call it owner's benefit. There's another official term is seller's discretionary earnings, other than seller's discretionary cash flow. Because the importance of the earnings of that business are critical to value.